Have you ever wondered what actually separates the 1% in trading from everyone else? What actually makes you make trading seem so effortless to other people who actually find trading to be this most difficult thing they've ever attempted to understand, ever attempted to get good at in their life? What actually separates the 1% from everyone else? Well, in this video, I'm going to be sharing with you some basic building blocks when it comes to trading the financial markets. And obviously it's centered around fundamental analysis, because you know that is my jam. Fundamental analysis, macroeconomics, that is my jam, right? So that is essentially what I want to share or break down with you in today's video. So starting off, obviously today we had the Reserve Bank of Australia interest rate decision, right? And obviously they left interest rates unchanged at 4.35%. But here's the key takeaway. Here's some of the takeaways from today's meeting. They said underlying inflation remains too high. Inflation is not expected to return sustainably to the midpoint of the target until 2026. The labor market remains tight and demand for labor is strong. So just looking at these three takeaways or headlines, you can essentially come to the conclusion that we do not expect interest rates to go lower anytime soon for the Australian economy. And obviously, if you watched some of my previous videos where I've looked at interest rates and how interest rates actually drive the different asset classes, then that should not be a should be a no-brainer sort of trade or position for you. But no, I'm not saying that it is easy, but if you've been watching my videos and actually applying what I've been sharing in my videos, then this should have been one of those positions that you wouldn't have essentially missed, right? But essentially, if we continue to read, it goes on to say, this is not a central bank signaling a rate cut. Higher for longer is the read here, right? And then they continue to say, if there is anything encouraging for those looking for rate cuts, it's that the bank revised growth and underlying inflation forecast down slightly. Analysts were looking for a February rate cut going into this meeting, while market pricing was around May next year, obviously 2025. I don't think those expectations will hold in the face of today's policy statement from the bank, right? See higher for longer remark above, because this specific headline, underlying inflation remains too high, that is in the actual statement. If you read the statement from the Reserve Bank of Australia, this specific headline is in that statement, right? So essentially, what is he talking about when he says they revised their projections lower? Because if you see, they currently see inflation at 2.6%, which is the headline in December. That is within the 1 to 3% target band. But the trimmed mean, which is the core, is expected or projected to be around 3.4% in December, and only to be at 3% in June 2025 and below 3% in December 2025, and only reach the midpoint of the 1 to 3% target range, which is 2.5% in December 2026. So that is telling you or showing you that the central bank is not actually anticipating or expecting any interest rate cuts in 2024. Not to say things may not change. Obviously, things can change. Data can change, right? A lot of things can still happen. We're still in November. We still have November and December, essentially in the beginning of November, right? So a lot can still happen. But based on the data that we have right now, it is not signaling that that the Reserve Bank of Australia should actually consider lowering interest rates. Obviously, this is now based on what they've said in today's meeting. But if we look at what the data that we had last week, which was the Australian dollar in inflation data, let's actually go to previous week, because a lot of people actually paid attention to the headline inflation, which actually showed that inflation is now within the 1 to 3% target range, right? And everyone was so caught up on that, but they failed, not necessarily that they failed, but they overlooked what is actually a better indication of domestic inflationary pressures, right? So if you can clearly see, inflation rate year over year, which is headline, actually dropped from 3.8 to 2.8%, which is now well within the 1 to 3% target, which is good. And then people were saying that, okay, now we should expect interest rate cuts from the Reserve Bank of Australia. Also because the monthly CPI fell even further from 2.7 to 2.1%, below the 2.4 that was expected. But core inflation, which is the RBA trimmed mean, actually dropped from 4% to 3.5%, in line with what was projected. Obviously, if you look at the headline inflation, what we've seen recently is the fact that almost on all economies, or for all economies, headline inflation has actually went lower. Why? Because oil prices have essentially been falling the whole of 2024, right? Or let me say, for the most of the second half of 2024, oil prices have been falling, and headline inflation takes into account volatile items such as food and energy prices, but core inflation excludes those volatile items. So core inflation is a better indication or representation of what, of that domestic demand, which is, domestic inflation, which is what it's generally called, or inflationary pressures, right? And monetary policy will work more, or not necessarily will work more, but the effects of monetary policy will be more visible on the core inflation side compared to the headline inflation, because headline inflation can be impacted by energy prices. If energy prices are going up, then headline inflation is going to go up, but you won't see that with core inflation. So that is very important for us to understand. And why am I sharing this with you? Because based on the understanding of this, that is how I was actually able to do what? Actually able to scale in another buy position on AUD NZD, because you know the buy positions that I have on AUD NZD that I executed around end of September, beginning of October, and I also added another buy position last week. Why? Because the CPI data showed that there's still inflationary pressures in the Australian economy. Not to say that growth is not slowing. Yes, growth is slowing because the higher interest rates remain for longer, then the more they're going to impact what, the actual economy or economic growth. But nonetheless, the inflationary pressures still remain there. They still remain evident. They still remain persistent. And based on what we got today from the Reserve Bank of Australia actually coming out and saying that they actually see that underlying inflationary pressures remain too high, then that is just confirming what we had already anticipated based on the data, right? And then obviously this week we also have the unemployment data for New Zealand, or for the New Zealand economy, and it is expected to increase from 4.6 to 5%. If that happens, then we can expect further dovishness or weakness for the New Zealand economy, dovishness or dovish tone from the Reserve Bank of New Zealand, because already they had projected that the New Zealand economy is going to experience a contraction in the second quarter as well as the third quarter. And obviously in the second quarter, yes, GDP actually showed a contraction of negative 0.5%, right? Now, if we do get another contraction in the third quarter, then that will obviously mean what? A technical recession. So things are not really looking so good for the New Zealand economy compared to the Australian economy. Now, where am I getting to with this? I'm getting to the fact that on something that I've emphasized in other videos, or in my previous videos as well, that it is all about central bank divergence, especially when it comes to trading currencies. If you can get good at identifying central bank divergence, then you exponentially increase your chances of trading actually working for you. I'm not saying that trading is going to work for you, but I'm saying that by just getting good at understanding central bank divergence, then you exponentially increase the likelihood of trading actually working for you, because at that point you've minimized the guesswork. And if you've seen most of my trades, most of the guesswork isn't there. Yes, I might not be 100% sure that this is how the market is going to behave, but I have a higher degree of conviction and confidence because of what? Because of the fundamental story that I have, or the fundamental case, the fundamental facts that I have, right? So what essentially separates the 1% from everyone else when it comes to trading, it is pretty much understanding macroeconomics, understanding fundamentals, right? If you're neglecting fundamentals, if you're ignoring fundamentals, if you feel that fundamentals are useless, then you might continue feeling stuck. You might continue experiencing challenges when it comes to your trading, or this feeling that trading is the most difficult thing you've ever attempted to do. Yes, that's how I also felt when I started, but I came to the realization that at the end of it all, if I have knowledge that works 100 times more better or 100 times efficiently than other knowledge that we have around trading, then that should make my trading simpler to a certain extent. And that is what I've experienced with fundamentals. But obviously, the learning curve of getting to understanding fundamentals and also being good at interpreting fundamentals comes with time, comes with practice. But if you start your journey today exploring fundamentals and just making it your objective, at least that beginning of 2025 you have a grasp on fundamentals, then your trading could potentially take a turn, or could potentially take a positive turn, right? So that is essentially what I wanted to share with you in today's video. Obviously, we do have the US elections today, and we are awaiting the outcome of that, which obviously won't happen anytime soon, but probably in the next couple of hours or so, we should start getting some bit of results trickling in, right? Obviously, that is where the market is currently focusing on, but I'm just sharing this with you guys to emphasize the point once again of the significance or importance of understanding macroeconomics whenever you are engaging in the financial markets, right? And getting good at understanding, getting good at interpreting macroeconomics so that you can, to a certain extent, position yourself ahead of time, position yourself on the path of flow, or on the path of those higher probability trades or higher probability positions, right? So that is what I wanted to share. And if you found value from this video, then you're definitely going to like this video that is going to pop up now on the screen. So you can watch that video next.